That brings us to the impacts of elections on the market. So I am going to go ahead and bring Rocky back on. So Rocky, it's all yours.
Okay, thank you. Very good information. And things are moving in the right direction. So that's good to see. Okay, I wanted to talk a little bit, just a few minutes, on the impact of elections on the markets. It's a call that comes into the office once in a while, and people are wondering, hey, what actually happens to the stock market during election cycles? And we're going to talk just a little bit about the historical perspective. I'll get out of the way here so you can see the whole title. But let's look at some questions. Which political party has been better for investors? Okay, we've got an election coming up here, and could be a change in the White House. But let's look at the data, historical data. So what this picture is showing, since 1933, it is showing the presidencies, and whether it was a Democratic presidency in blue or a Republican presidency in red, and what has happened to the S&P since 1933. And I think it's pretty easy to see that you got pretty much a straight line. There's nothing substantial that says, hey, there was a period when a Democrat or a Republican was in the White House that there wasn't growth in the market. In fact, in 1933, if you had invested $1,000 in the S&P, you would be worth over $10 million gross growth in 2018. That is an amazing number. So U.S. stocks have trended up regardless of whether a Democrat or Republican won the White House. What typically happens to the stock market during an election year? Okay, that's a big concern. So what we've got here is a chart that goes from January, the beginning of the year of an election year, through May of the following year. So giving us about an 18-month perspective. When you look at these two lines, the dark blue is non-election years, and the light blue is what has historically happened during election years. So these are averages since 1932 of what the stock market has done month by month, whether it's an election year or non-election year. If you notice, in May through September, there's a big, big difference whether it's an election year or not election year. The light blue line drops significantly going into the summer during an election year. During a non-election year, it tends to go up in the second quarter into the summer. And then, however, it comes back in the election year, and by September, as we get closer to the election day, you'll notice the light blue line is coming down again, signaling another correction. So literally, historically, there are a couple of major corrections in the market in an election year, which is different than a non-election year, which is the dark blue line above it. So you can see that, hey, we're in an election year, and we had COVID, and we had a market correction, right? We had a major drop in the market, but the market did come back throughout the summer. And what are we experiencing now in September? We're starting to experience another correction. So it seems to be following this pattern. But if you look at the lines moving forward, there's definitely an upward trend in after the election day, moving forward historically. So we seem to be following, at least into September, this kind of a pattern. What sectors have done best in election years? You may be thinking, well, tech has really boomed in the summer and now it's correcting again. But if we look at 2016, let's go back to the last election, and let's look at healthcare, the healthcare sector versus the overall S&P. The healthcare is the blue line, and the S&P in general is the gray line. And you can see in the first shaded area titled the 2016 election cycle that the healthcare actually was outperforming the S&P until the election cycle. And then there was a major correction that had taken place. Why? Because there was a lot of talk about policies and proposals during the election campaign, and it was going to impact the healthcare industry. right? But as we got through that, look what happened. The healthcare continued to rise with the S&P. So what is the point of this chart? In 2016, going into the election, we saw buying opportunities in certain sectors because they were being impacted in the short term by the policies that were being proposed by the candidates. However, if you would have bought the healthcare sector right before the election, you'd have seen huge growth from 2016 through now. And now we're entering that cycle again. And the question is, what are the money managers doing? And that's what I stated up front, was that we're selectively looking for those appropriate valuations, those opportunities. We've got a market correction taking place now. We've kind of seemed to enter that. And what are the things that we should be buying at a lower price? And that is going on. What mistakes do investors often make in election years? This chart is tracking basically the 4 years of a term of a president. So year 1 of the presidency, year 2, year 3, and year 4. That's what's along the bottom of the graph. And then the blue bar represents funds going into the equity markets. So the inflows of money into the equity markets. So if you look at year 1, equity funds increased significantly in the first year of a presidency. Money funds, not so much, which is the greenish blue bar. Year 2, same thing. Equity funds, money's flowing into equities, not so much into money market funds. But look what happens in years 3 and 4. Investors get concerned. Investors are maybe a little bit skittish of investing in the market because they don't know what's going to come. And you see equity flows decrease and money market flows increase substantially. What does that mean? Money's coming out of the market. That's another reason that we kind of see this double dip taking place, is that funds tend to flow out of equity markets as investors get concerned. The big question is, should that be happening? And what we've done here is looked at what would have been the best ways maybe to invest in election years. And here's 3 hypothetical $10,000 investment strategies during an election cycle. And again, this is all historic data based off of what's happened in the past. So if you were fully invested, the dark blue is saying if I was fully invested on January 1 of an election year, 4 years later, my $10,000 investment would grow to $15,866 historically. The light blue bar is, what if I was contributing to my 401k and I couldn't put all in at the beginning of the year, but I could put in X amount of dollars every month for the $1,000 a month for the first 10 months starting in January. That also, $10,000 would grow to $15,729. Not quite as good as the initial upfront investment, but remember I said election years are volatile years. So sometimes you're putting in when the market's up, sometimes you're putting in with the market down. So you're dollar cost averaging, and that's very effective to get that rate of return, okay? And then the kind of reddish brown bar sitting on the sidelines. I took my $10,000, put it in a money market, and waited to next year and put it in the market. And you can see there was a significant less amount of money made waiting 1 year, even though we know there's volatility in an election year. And then when you look at the circles on the right side of this chart, you see the best outcome and the worst outcome. So for the person that put all the money in up front, 14 out of 22 times, that was the best way to invest during that presidency. 6 out of 22 times, it was the worst way to invest. Okay. And then for the consistent, the 401k contributor, 5 of the 22 cycles, that strategy worked the best. But conversely, it was never the worst way to invest during that presidency for 4 years. And finally, if you stayed in cash, you were wrong 16 out of 22 times by doing that. So it was only the best strategy 3 out of the 22 presidency cycles that were being studied here. So the point is, we know it's volatile, but you will come out ahead, historically speaking, by just staying in the market. So what have we learned about elections and markets? U.S. stocks have trended up regardless of whether there's a Republican or Democrat in the White House. $1,000 investment in the S&P index when FDR became president in 1933 would have been worth over $14 million through September of 2020, August of 2020. Primary season tends to be volatile, but markets have bounced back strongly afterward. So we've seen that in the charts. Investors often get nervous and move to cash during election years. Net asset flows into money market funds have been more than 3 times higher in election years than non-election years. However, staying on the sidelines has rarely paid off. Remember, only 3 out of the 22 presidency cycles that were studied. It's time in the market, not timing in the market, that matters the most. In fact, stocks have had negative returns in only 2 of the last 20 elections, and that was the year 2000 and the year 2008, and both declines were largely attributed to asset price bubbles rather than politics. And we remember the dot-com bubble, and we remember the financial crisis in 2007 and 2008. So another thing is that, and the other charts I showed kind of represented this too, that market performance often reverses after an election. And we wanted to slice that information a little differently. And what this is showing, since we have a Republican in office now, what happens when the incumbent wins or loses. So the first 2 bars represent the incumbent party wins. And the black is what happened to the market in the election year and what happened the year after. So you can see that historically when the incumbent wins, whether Democrat or Republican, the market is up after the election. In second section, with the incumbent party losing, that the market tends to go down in that election year, but rebounds fairly strongly the following year. Okay. The third set, incumbent Republican wins. So the year of the election tends to be a very strong year for the market and still solid growth in the following year. And if the incumbent Republican loses, the market tends to go down in the election year, but rebounds very strong in the following year. So again, overall, do markets get impacted by elections? Yes. Does the investor that is in it for the long term lose as a result of staying invested? No. You generally come out ahead.